Mastering Forex Candlestick Pattern Analysis. Written by Robin Ahmed. Introduction. Candlestick charting is one of the most powerful tools available to Forex traders. With roots in 18th century Japanese rice markets, candlestick patterns are a time-tested method for interpreting market psychology and forecasting price movements. This book provides a comprehensive guide to understanding, identifying, and applying candlestick patterns in Forex trading. Chapter 1, Basics of Candlestick Charts. Candlestick charts are among the most popular and powerful tools in technical analysis. They provide a visual representation of price movements over a specific period, giving traders a quick and insightful understanding of market sentiment. Each candlestick tells a story: where the price started, how high and low it went, and where it ended, all within a single time frame. Anatomy of a candlestick. A candlestick consists of two main parts, the body and the wicks, also known as shadows. Here's what each element represents. Open, the price at which the asset began trading at the start of the selected time period. Close, the price at which the asset ended trading at the end of the time period. High, the highest price reached during that time frame. Low, the lowest price reached during that time frame. Body, the thick central portion between the open and close. It shows whether the asset gained or lost value during the period. Wick, shadow, thin lines above and below the body indicating the highest and lowest prices traded during the session. Visual summary. High. Upper wick. Open close, bullish, close open. Body. Close open, bearish, close open. Lower wick. Low. Note, if the close is higher than the open, the candle is bullish, usually green or white. If the close is lower, it's bearish, typically red or black. Bullish vs bearish candles. Understanding whether a candle is bullish or bearish is fundamental. Bullish candle. Close open. Indicates buying pressure. Typically colored green or white. The lower part of the body is the open, and the upper part is the close. Bearish candle. Close open. Indicates selling pressure. Usually colored red or black. The upper part of the body is the open, and the lower part is the close. These color-coded candles allow traders to quickly identify market trends and momentum. Time frames. Candlestick charts can be applied to virtually any time frame, making them versatile tools for different trading styles. 1-minute candles, ideal for scalpers and high-frequency traders. 5 or 15-minute candles, common in intraday trading strategies. Hourly candles, useful for short-term trend analysis. Daily candles, popular among swing and position traders. Weekly/monthly candles, essential for long-term investors. Regardless of the time frame, the anatomy and interpretation of candlesticks remain the same. What changes is the amount of data each candle represents. Why it matters. Reading candlesticks effectively allows traders to anticipate potential reversals or continuations. Gauge market strength and momentum. Time entries and exits more accurately. Combine with other technical tools, like support/resistance and indicators, for high-confidence trades. Chapter 2, Understanding Market Psychology. Behind every candlestick lies a deeper story, one of emotions, decisions, and reactions by market participants. Candlestick patterns are not just visual indicators, they are psychological footprints of the collective behavior of traders. Understanding this behavior is crucial to interpreting candlestick charts effectively and making better trading decisions. The psychology behind a candle. Every candlestick is a direct reflection of the battle between buyers and sellers during a particular time frame. The shape and size of each candle show which side was dominant, how strong that dominance was, and whether a change in momentum might be on the horizon. Let's break down the key psychological themes reflected in candlestick formations. 1. Indecision, the battle is even. When the market shows indecision, it means buyers and sellers are equally matched, with neither able to take control. This typically appears during consolidation phases or near potential reversal zones. Common visual traits: small real body, long upper and lower wicks, often forms after a strong trend, hinting at exhaustion. Example, dodgy candlestick. A dodgy is the most classic sign of indecision. The open and close are nearly equal, and the long wicks show price fluctuation without clear direction. Psychological meaning: traders are uncertain. Momentum is stalling. The next few candles are critical in confirming direction. 2. Momentum, one side in control. Momentum candles show strong conviction by either buyers or sellers. These typically occur mid-trend or at breakout points, where prices move rapidly with little resistance. Common visual traits: large real body, very short or no wicks, usually aligned with the trend direction. Example, Marubozu candle. A Marubozu has no wicks, just a solid body. This means price opened at one extreme and closed at the other with no hesitation. Psychological meaning: dominance. Buyers, or sellers, have full control. Likely continuation of the current trend unless met by major resistance/support. 3. Reversals, a change of sentiment. Reversal patterns reflect a shift in market sentiment. They often form near support or resistance levels, signaling a potential change in direction. Common visual traits: wick length shifts, example long upper wick after uptrend equals selling pressure. A large candle in the opposite direction after a trend. Multi-candle patterns that show transition. Examples: hammer, after a downtrend buying pressure overcomes initial selling. Shooting star, after an uptrend sellers reject higher prices. Psychological meaning: one side is losing strength while the other is gaining. Confirmation in the next candles is essential to validate the reversal. 4. Continuation, trend confidence. Continuation patterns occur during trends, showing temporary pauses before the trend resumes. These patterns reflect consolidation, not reversal, often caused by profit-taking or short-term uncertainty. Common visual traits: small-bodied candles following strong moves. Short consolidations like flags or pennants in price charts. Patterns that rest before the next breakout. Examples: rising 3 methods, a strong bullish candle, followed by a few small bearish candles, then another large bullish candle. Bullish/bearish harami, smaller candle within the body of a previous larger one. Psychological meaning: the market is catching its breath. Buyers, or sellers, are preparing for another push in the same direction. Why market psychology matters. Understanding the sentiment behind candlesticks allows traders to avoid false signals by interpreting context. Read the emotional temperature of the market. Act with confidence during volatile situations. Time entries/exits by anticipating shifts in control. Conclusion: candlestick charts are a direct line into the emotions and decisions of the market crowd. Recognizing patterns of indecision, momentum, reversal, and continuation gives you an edge not just in reading charts, but in understanding the forces that drive price. In the next chapter, we'll explore specific single candle patterns and how they embody the principles of market psychology you've learned here. Chapter 3: Single Candlestick Patterns. Single candlestick patterns are standalone formations that can signal changes in market sentiment or confirm existing trends. These patterns are critical for traders to recognize because they often precede price action shifts, either reversals or continuations. 1. Doji. Definition: a candlestick where the open and close prices are virtually identical, forming a very thin or non-existent body with long wicks on one or both sides. Psychology: doji reflects indecision in the market. Neither bulls nor bears gain clear control, suggesting a potential pause or reversal, especially if it appears after a strong trend. Types of doji: standard doji, equal wicks. long-legged doji, very long wicks. Gravestone doji, long upper wick. Dragonfly doji, long lower wick. Example scenario, after a long bullish trend, a doji forms hinting at buyer exhaustion and a potential reversal. 2 hammer. Definition, a bullish reversal pattern appearing at the bottom of a downtrend. It features a small body near the top of the candle and a long lower wick, at least twice the body length. Psychology, sellers drove the price down during the session, but buyers regained control and pushed the price back near the open. This shift signals bullish intent. Ideal conditions. Appears after a downtrend. Confirmation candle, a bullish close, strengthens the signal. Example scenario, following several red candles in a downtrend, a hammer forms with a long lower wick. The next candle opens higher and closes green, confirming the reversal. 3 inverted hammer. Definition, a small-bodied candle with a long upper wick, forming at the bottom of a downtrend. It resembles an upside-down hammer. Psychology, bulls attempted to rally but couldn't hold gains. However, the failed breakdown suggests weakening bearish strength and potential bullish reversal. Key point, needs confirmation by a bullish candle closing above the inverted hammer. Example scenario, in a downtrend, an inverted hammer forms. The next day, a large green candle breaks the recent high triggering long positions. 4 shooting star. Definition, a bearish reversal pattern that looks like an inverted hammer but occurs after an uptrend. It has a small body and a long upper wick. Psychology, bulls pushed the price higher, but sellers overwhelmed and forced a close near the open. This signals potential exhaustion of buying pressure. Ideal context. Appears at the top of an uptrend. Needs confirmation by a bearish candle. Example scenario, after several green candles, a shooting star forms. The next candle opens lower and closes red, suggesting a shift in trend. 5 spinning top. Definition, a candlestick with a small real body and long upper and lower wicks. It indicates a tug of war between buyers and sellers. Psychology, market participants are undecided. Price fluctuated both up and down, but closed near the opening price. Interpretation. In a strong trend, it may indicate a pause or weakening momentum. May be followed by a reversal or consolidation. Example scenario, a spinning top appears after a sharp move up. The next candles show price slowing and eventually reversing. 6 Maribozu. Definition, a full-bodied candle with no wicks, either bullish, green/white, or bearish, red/black. It represents strong momentum in one direction. Bullish Maribozu, opens at the low, closes at the high. Bearish Maribozu, opens at the high, closes at the low. Psychology, one side dominates completely. A strong indication of conviction in the direction of the candle. Usage. As a breakout signal. As trend continuation confirmation. Example scenario, a bullish Maribozu appears after consolidation, breaking out of a resistance level, suggesting strong buying interest. Chapter 4, Dual Candlestick Patterns. While single candlestick patterns offer insights into price behavior, dual candlestick patterns are often more reliable because they reflect a shift in sentiment over 2 sessions. These combinations capture the battle between buyers and sellers and are useful for identifying reversals or continuations. Let's explore 4 of the most recognized and widely used dual candlestick patterns. 1. Engulfing pattern. The engulfing pattern is a strong reversal signal that occurs when a smaller candle is completely engulfed by a larger one in the opposite direction. Bullish engulfing formation, a small red, bearish, candle is followed by a large green, bullish, candle that fully covers the previous candle's body. Occurs at the bottom of a downtrend. Psychology, bears dominate the first session, but bulls overpower them in the second. This suggests a shift from selling pressure to buying interest. Example scenario, After a few red candles in a downtrend, a green candle opens lower but closes much higher than the previous day's open, signaling buyers stepping in with force. Bearish engulfing formation: a small green, bullish, candle is followed by a large red, bearish, candle that completely engulfs the first candle's body. Occurs at the top of an uptrend. Psychology: the bulls lose strength as bears take control, often indicating a potential reversal to the downside. Example scenario: in an uptrend, a strong bearish candle follows a small bullish one, engulfing it entirely. The market sentiment has shifted towards selling pressure. 2 tweezer tops and bottoms. Tweezer patterns are formed when 2 consecutive candles have matching highs or lows, typically indicating a potential reversal. Tweezer tops formation: 2 candles with identical highs at the top of an uptrend. The first candle is usually bullish, the second bearish. Psychology: bulls push price to a resistance level but fail to move beyond it on both attempts. Sellers begin to dominate on the second attempt. Example scenario: after a green candle reaches a high, the next red candle tests the same high but fails to break above, indicating a bearish turn. Tweezer bottoms formation: 2 candles with identical lows at the bottom of a downtrend. The first candle is usually bearish, followed by a bullish one. Psychology: sellers attempt to break a support level but are rejected both times, showing growing buyer interest. Example scenario: a red candle touches a low, and the next green candle forms with the same low, suggesting support is holding firm. 3 piercing pattern, bullish reversal. The piercing pattern is a strong bullish reversal setup formed after a downtrend. Formation: a red, bearish, candle is followed by a green, bullish, candle that 1 opens below the previous low, but 2 closes above the midpoint of the red candle's body. Occurs after a downtrend. Psychology: bears dominate early, but bulls regain control and close above the halfway point, creating a reversal signal. Example scenario: a strong red candle is followed by a green candle that opens lower but closes above 50% of the red body. Traders recognize this as bullish momentum building. 4 dark cloud cover, bearish reversal. The dark cloud cover is the bearish counterpart to the piercing pattern and signals a potential downward reversal. Formation: a green, bullish, candle is followed by a red, bearish, candle that 1 opens above the previous high, but 2 closes below the midpoint of the green candle's body. Occurs after an uptrend. Psychology: bulls start strong, but bears push back hard and close the session deep into the previous candle. This shift shows weakening buyer confidence. Example scenario: a green candle forms in an uptrend. The next candle opens higher but ends up closing deep below the midpoint of the prior green candle, signaling potential for a bearish reversal. Comparison table of dual candlestick patterns. Conclusion: dual candlestick patterns provide more context than single candles. They show a transition in power between buyers and sellers, offering key clues about trend reversals. Recognizing and confirming these patterns with volume, support/resistance, or other indicators can significantly enhance your trading strategy. Chapter 5: Triple Candlestick Patterns. Triple candlestick patterns are some of the most reliable indicators of a potential reversal or continuation in the market. They combine 3 consecutive candlesticks to convey a more definitive shift in momentum and sentiment. These patterns often appear at key turning points and are particularly valued for their predictive strength. 1 Morning Star, bullish reversal. Definition: the morning star is a 3-candle pattern that appears after a downtrend and signals a potential bullish reversal. Structure: first candle, a long red, bearish, candle showing strong downward momentum. Second candle, a dodgy or small-bodied candle indicating indecision. Third candle, a long green, bullish, candle that closes well into the body of the first candle. Psychology: bears are in control during the first session. The second candle shows weakening momentum and market hesitation. Bulls take over in the third session, reversing the trend. Example, after several days of falling prices, a red candle forms, followed by a doji, then a strong green candle that breaks above the midpoint of the red candle, triggering bullish sentiment. 2. Evening star, bearish reversal. Definition: the evening star is the bearish counterpart to the morning star. It appears at the top of an uptrend and signals a bearish reversal. Structure: first candle, a strong green, bullish, candle. Second candle, a doji or small-bodied candle representing indecision. Third candle, a large red, bearish, candle closing well into the body of the first candle. Psychology: bulls dominate the first candle. The market loses momentum on the second candle. Bears take over and push prices lower in the third session, indicating a trend change. Example, after an extended rally, a green candle is followed by a small-bodied candle, and then a large red candle that closes deep into the first candle's body, signaling an end to the bullish move. 3. White soldiers, bullish continuation. Definition: this pattern consists of 3 consecutive long green, bullish, candles, typically forming after a period of consolidation or a pullback, and indicates bullish strength. Structure: each candle opens within or near the previous candle's body. Each candle closes progressively higher. Wicks are usually small or non-existent, showing strong buying pressure. Psychology: continuous buying interest and confidence from bulls. Often confirms the start of a new uptrend or strengthens an existing one. Example, following a downtrend or range-bound period, 3 strong green candles form in succession, each with higher closes attracting buyers to the bullish breakout. 4. 3 black crows, bearish continuation. Definition: the bearish counterpart to the 3 white soldiers, this pattern features 3 consecutive red, bearish, candles and suggests strong downward momentum. Structure: each candle opens within or near the previous candle's body. Each closes lower than the last. Small or no lower wicks, showing consistent selling pressure. Psychology: bears maintain control over 3 sessions. Confidence in selling increases with each successive candle. Often follows a failed breakout or a peak in price. Example, after a bullish run, 3 large red candles appear one after another, closing lower each time, indicating that the trend is turning bearish. 5. 3 inside up/down. This pattern represents a reversal setup using an inside bar concept where the second candle forms within the range of the first candle, followed by confirmation on the third. 3 inside up, bullish reversal. Structure: first candle, long red candle, downtrend context. Second candle, small green candle completely within the first candle's body. Third candle, strong green candle that closes above the first candle's open. Psychology: bears dominate initially. Bulls start to emerge in the second candle. A decisive third candle confirms bullish reversal. Example, in a downtrend, a red candle is followed by a smaller green one that stays within its range. A large green candle then breaks above the red candle's open, confirming buyer control. 3 inside down, bearish reversal. Structure: first candle, long green candle, uptrend context. Second candle, small red candle within the first candle's body. Third candle, strong red candle that closes below the first candle's open. Psychology: bulls initially control. Bears start to push back. The third candle confirms that bears have taken over. Example, in an uptrend, a large green candle is followed by a small red one, then a longer red candle closes below the green candle's open, confirming a reversal. Conclusion: triple candlestick patterns are some of the most powerful indicators in technical analysis. Their multi-candle structure provides more confirmation and context, reducing false signals. However, they are best used with additional confirmations, such as volume analysis. Support/resistance zones. Trend lines or indicators like RSI/MACD. Recognizing these patterns in real time can provide traders with high probability setups and clearer insights into market psychology. Chapter 6, Advanced Candlestick Patterns. As traders gain experience, they begin to look beyond basic reversal and continuation patterns to more advanced structures that hint at momentum shifts, consolidation, and trend continuation. These advanced candlestick patterns can be powerful signals when confirmed with volume, support/resistance, or other technical indicators. 1. Harami, bullish or bearish. Definition: the Harami pattern is a two-candle formation where a small-bodied candle, either bullish or bearish, is completely contained within the body of the previous larger candle. Bullish Harami appears in a downtrend. First candle, long red, bearish. Second candle, small green, bullish, inside previous body. Bearish Harami appears in an uptrend. First candle, long green, bullish. Second candle, small red, bearish, inside previous body. Psychology: the Harami signals indecision or a pause in the current trend. The smaller second candle indicates a weakening of momentum, possibly leading to a reversal. Example: in a downtrend, a strong red candle is followed by a small green candle that fits completely inside the red one, showing that sellers are losing control. 2. Harami cross. Definition: a variation of the Harami, where the second candle is a doji, open and close are nearly equal, reflecting extreme indecision in the market. Appears in both uptrends and downtrends. Second candle, doji, fits entirely within the previous candle's body. Psychology: the doji adds extra weight to the Harami pattern, as it signals hesitation or conflict between buyers and sellers, often preceding a reversal. Example: a large bullish candle is followed by a doji fully inside its body. Bulls are losing control, and the next move could be a bearish reversal. 3. Kicker pattern. Definition: one of the most aggressive and reliable reversal patterns. The second candle opens with a gap in the opposite direction and continues strongly. Bullish kicker. First candle, strong red, bearish. Second candle, opens above the first and closes green, with no overlap. Bearish kicker. First candle, strong green, bullish. Second candle, opens below the first and closes red. Psychology: a total sentiment shift often caused by a news event or surprise. The gap reflects panic or enthusiasm, and the strong move confirms the reversal. Example: a large red candle is followed by a gap up and a large green candle. It's a clear message: bulls have taken over decisively. 4. Rising and falling 3 methods. These are trend continuation patterns consisting of 5 candles. Rising 3 methods, bullish continuation. First candle, long green candle. Next 3 candles, small-bodied red candles that stay within the range of the first candle. Fifth candle, strong green candle closing above the first candle. Psychology: temporary consolidation or profit-taking before the trend resumes. Bears try to push back but fail. Falling 3 methods, bearish continuation. First candle, long red candle. Next 3 candles, small green candles within the red candle's body. Fifth candle, strong red candle closing below the first candle. Example: in an uptrend, a strong green candle is followed by 3 small reds, within its range, then another green candle breaks out confirming bullish continuation. 5. Mat hold pattern, bullish continuation. Definition: a rare but powerful bullish continuation pattern resembling the rising 3 methods but with more resilience and strong momentum. Structure: 1 long green candle. 2 small red candle that gaps up. 3 2 or more small red or green candles that stay above the first candle's close. 4 final long green candle that closes higher. Psychology: shows strength from bulls. Even during a pause, price never retreats below the bullish breakout point, reinforcing upward pressure. Example, a strong green candle followed by a few small candles with higher lows and then a breakout green candle indicating relentless bullish strength. 6. Tajiki gap, bullish or bearish continuation. This is a gap continuation pattern, signaling that the trend is intact after a brief pullback. Bullish Tajiki gap. First candle, green. Second candle, another green candle that gaps up. Third candle, red candle that closes into the gap but does not fill it. Bearish Tajiki gap. First candle, red. Second candle, another red candle that gaps down. Third candle, green candle that closes into the gap but doesn't fill it. Psychology, a slight retracement that fails to close the gap, confirming the trend's strength. Gaps remain unfilled, which often signals conviction in the direction. Example, two strong green candles with a gap between them are followed by a red candle that closes into the gap but doesn't fill it. The trend is still up. Conclusion. These advanced candlestick patterns offer deeper insights into market dynamics. While they may be less common than basic formations, they often lead to high probability trade setups when confirmed with other signals like volume surges, key support/resistance levels, trend lines or moving averages. Understanding these advanced structures allows traders to better anticipate price action and refine their entry and exit points in complex market conditions. Chapter 7, Candlestick Patterns in Context. Candlestick patterns offer powerful insights into market sentiment and potential price movements. However, they should never be used in isolation. The context in which a pattern forms is just as important, if not more, than the pattern itself. This chapter teaches how to validate candlestick patterns using support/resistance, trend lines, indicators, and volume, ensuring higher probability trades and reducing false signals. 1. Support and resistance, the foundation of price action. Definition: support is a price level where buying interest is strong enough to prevent the price from falling further. Resistance is the opposite, where selling pressure halts upward momentum. Why it matters: candlestick patterns at key support or resistance zones are more reliable. Examples: a hammer forming at a support level is more meaningful than in the middle of a range. A bearish engulfing at a long-standing resistance zone suggests a potential trend reversal. Application: draw horizontal lines where price has historically reversed. Wait for patterns like doji, harami, or engulfing to appear at these levels. 2. Trend lines and channels, confirm market direction. Definition: trend lines connect swing highs or swing lows to define the overall direction. Channels consist of two parallel lines, defining a trading range in an uptrend or downtrend. Why it matters: patterns that align with the trend or occur at the boundary of a trend line/channel offer higher accuracy. Examples: 3 white soldiers forming off an ascending trend line confirm bullish strength. Shooting star near the upper boundary of a rising channel can indicate a reversal. Application: draw trend lines to identify the prevailing direction. Use candlestick patterns to time entries or exits based on bounces or breaks. 3 indicators, adding confluence to your analysis. Definition: technical indicators help quantify market behavior, momentum, and potential reversals. Popular indicators: RSI, Relative Strength Index, measures overbought or oversold conditions. MACD, Moving Average Convergence Divergence, shows trend strength and potential crossovers. Moving averages, smooth price action and identify trend direction. Why it matters: when a candlestick pattern aligns with indicator signals, it boosts the reliability of the trade setup. Examples: a bullish harami forming when RSI is oversold, below 30, signals a strong reversal opportunity. A bearish engulfing confirmed by a MACD bearish crossover increases confidence in a short trade. Application: use indicators to confirm the strength, momentum, or overbought/oversold status of a market. Combine with patterns like doji, morning/evening star, or kicker for confirmation. 4. Volume, the hidden power behind price. Definition: volume shows how many shares or contracts are traded during a period. It's a critical tool for validating the strength of a candlestick pattern. Why it matters: patterns forming on high volume are more likely to result in significant price moves. Examples: a Maribozu on high volume suggests conviction behind the move and potential trend continuation. A doji on high volume may indicate significant indecision or a trap, requiring caution. Application: look for volume spikes during the formation of key patterns. Confirm breakouts or breakdowns from patterns, example Tajiki gap, or 3 methods, with increased volume. Real-world trade setup example. Scenario: price is in a downtrend. A hammer forms at a long-term support zone. RSI is at 28, oversold. Volume increases on the hammer candle. A bullish MACD crossover follows. Conclusion: all conditions align: candlestick context, support, indicators, and volume signaling a high probability long trade setup. Quick checklist: candlestick pattern confirmation. Conclusion: candlestick patterns are visual cues, not standalone signals. By combining them with key contextual tools, support/resistance, trend lines, indicators, and volume, traders can drastically improve the accuracy of their entries and exits. Remember, the pattern tells you what, but the context tells you when and where. Master both, and you move closer to mastering the market. Chapter 8: Trading Strategies Using Candlestick Patterns. Candlestick patterns are powerful tools, but success in trading requires more than just identifying them. A sound trading strategy integrates candlestick analysis with proper entry/exit planning, risk management, and indicator-based confirmation. This chapter will guide you through creating reliable, rule-based trading strategies using candlestick patterns. 1. Entry points: enter at pattern confirmation. Definition: an entry point is where you open a trade. For candlestick strategies, you wait for the pattern to complete and confirm before entering. How to confirm: wait for the next candle after the pattern to close in the expected direction. Ensure the pattern forms at a significant level, support, resistance, or trend line. Examples: after a bullish engulfing at support, enter long when the next candle breaks the high of the engulfing candle. For a shooting star at resistance, enter short when the next candle breaks below its low. 2. Exit points: set profit targets near support/resistance. Definition: an exit point is where you close your trade to take profit. Candlestick-based trades often target key support/resistance levels or Fibonacci retracements. Exit tips: place profit targets just before resistance, if long, or support, if short, to increase fill probability. Consider partial exits at intermediate levels for longer moves. Examples: in a hammer-based long trade, exit near the next swing high or previous resistance. In a 3 black crows short trade, aim for a previous demand zone. 3. Stop loss: protecting your capital. Definition: a stop loss limits your loss by closing the trade if the price moves against you. Rule of thumb: place the stop below the low of a bullish pattern, example hammer. Place the stop above the high of a bearish pattern, example shooting star. Examples: for a morning star, stop goes below the pattern's lowest point. For a bearish harami, stop goes above the high of the first, bullish, candle. Pro tip: always set a stop loss, never risk more than 1 to 2% of your capital on a single trade. 4. Risk-reward ratio: trade quality over quantity. Definition: the risk-reward ratio compares how much you're risking to how much you aim to gain. Best practice: maintain a minimum risk-reward ratio of 1:2, risk $1 to make $2. Only take trades that meet this minimum. How to plan: if your stop loss is 20 pips, target at least 40 pips. Use tools like the Fibonacci tool or support/resistance to estimate logical targets. Example. A trade with a 15-point stop and a 45-point target equals 1:3 ratio rightward arrow ideal setup. 5. Combining with indicators, filter and confirm. Definition: indicators add an extra layer of confidence to candlestick setups by confirming momentum, trend, or overbought/oversold conditions. Recommended indicators. RSI, look for divergence or overbought/oversold confirmation. MACD, use for trend confirmation, bullish/bearish crossovers. Moving averages, confirm overall trend and dynamic support/resistance. Examples. A hammer at support confirmed by RSI 30 and a bullish MACD crossover equals strong buy signal. A dark cloud cover with RSI 70 equals valid short setup. Practical trade setup example. Scenario. Market, EUR/USD. Candlestick pattern, bullish engulfing at 1.0850 support. Confirmation, RSI at 28, oversold, MACD bullish crossover. Entry, 1.0862, after breakout above engulfing candle. Stop loss, 1.0838, below pattern. Take profit, 1.0925, previous resistance. Risk, 24 pips. Reward, 63 pips equals 1:2.6 RR. Result, high probability setup supported by pattern, context, and indicators. Bonus, strategy templates. Basic reversal strategy. Pattern, hammer/engulfing/morning star. Location, at key support. Indicators, RSI 30, MACD crossover. Entry, break of pattern high. SL, below pattern low. TP, resistance or fib level. Trend continuation strategy. Pattern, rising 3 method/Marubozu. Trend, aligned with 50 EMA. Entry, on breakout candle. SL, below previous swing low. TP, next major resistance. Conclusion. Trading candlestick patterns with a structured strategy transforms randomness into a disciplined, rule-based system. By combining entries with clear exits, controlled risk, and confirmation tools, you elevate your edge in the market. Key takeaway: patterns are signals, but strategy is your roadmap. Always plan your trades and trade your plan. Chapter 9, Real Chart Examples and Case Studies. Candlestick patterns gain meaning when applied in the real world. This chapter explores actual trade setups, including step-by-step analysis, annotated patterns, and key takeaways from both winning and losing trades. Understanding why a trade worked or didn't builds trader intuition and strengthens your edge. 1. Bullish engulfing at support, a winning trade. Market, USD/JPY, daily chart. Pattern, bullish engulfing. Context, strong horizontal support at 131.50. Indicators, RSI at 29, oversold, MACD flattening. Step-by-step analysis. 1. Price approached a multi-tested support zone at 131.50. 2. A small red candle formed, followed by a large green candle engulfing the red one. 3. RSI signaled oversold conditions, suggesting a potential bounce. 4. MACD was flat, with potential for a crossover. 5. Trade entry, above the green engulfing candle at 132.10. 6. Stop loss, below the pattern at 131.20. 7. Take profit, previous swing high at 134.60. Outcome. Trade hit TP within 4 days. Reward risk equals 2.5:1. Key lesson: combining patterns with support and indicator confluence significantly increases success probability. 2. Evening star at resistance, a winning reversal. Market, EUR/USD, 4H chart. Pattern, evening star. Context: price hit previous resistance at 1.0930. Indicators: bearish divergence on RSI. Step by step. 1. Price rallied into previous resistance. 2. First candle, large bullish, momentum. 3. Second candle, dodgy, signaling indecision. 4. Third candle, strong bearish candle closed below midpoint of first. 5. RSI showed lower highs despite price making higher highs. 6. Trade entry, below third candle at 1.0895. 7. Stop loss, above pattern at 1.0940. 8. TP, support zone at 1.0820. Outcome: price reversed quickly, hit TP in 6 hours. Key lesson: evening star patterns near resistance, confirmed by divergence, offer reliable reversals. 3. Hammer at mid-trend, a losing trade. Market: GBP/USD, 1H chart. Pattern: hammer. Context: formed mid-trend, not near support. Indicators: no divergence, neutral RSI. Step by step. 1. Uptrend was slowing, and a hammer formed. 2. Entered long on break above hammer candle. 3. Set stop loss just below the hammer's low. 4. Price reversed instead and broke below hammer, triggering stop. Outcome: loss-1R. Key lesson: even strong-looking patterns like the hammer should only be traded at key support zones or trend reversals. Context is everything. 4. 3. Inside up with volume spike, a solid win. Market: Tesla stock, daily chart. Pattern: 3. Inside up. Context: formed after strong downtrend at Fibonacci 61.8% retracement. Indicators: volume spike on third candle. Step by step. 1. First candle, large bearish body. 2. Second candle, small bullish inside body. 3. Third candle, strong bullish candle closing above first. 4. Significant volume confirmed buying interest. 5. Trade entry, break of third candle at $182.40. 6. SL, below second candle at $176.90. 7. TP, $195, previous resistance. Outcome: reward risk equals 2:1, trade hit target in 5 sessions. Key lesson: volume confirmation enhances the credibility of reversal patterns like 3 inside up. Annotated chart snapshots. Here we typically include actual annotated charts highlighting entry point, stop loss, take profit, pattern shape, contextual clues like support/resistance, RSI, or MACD overlays. If you'd like, I can generate example chart illustrations for each of these setups. Conclusion: real chart examples help move candlestick theory into actionable trading setups. The difference between a profitable and losing trade often comes down to where a pattern appears and how well it's supported by other technical tools. Key lessons recap. Patterns alone are not enough, context matters most. Winning trades often show confluence, pattern plus support/resistance plus indicators. Losing trades usually miss one of those elements. Chapter 10, Common Mistakes and How to Avoid Them. Even the most reliable candlestick patterns can fail if misused. This chapter addresses the most common pitfalls traders face when using candlestick patterns and provides actionable solutions to help you avoid them. 1. Trading patterns without confirmation. Mistake: entering trades based on a single candlestick formation without waiting for price confirmation. Why it's risky: many candlestick patterns can form due to random market noise. Without confirmation, you may enter a trade that has no real momentum or direction. Example: a shooting star forms at resistance. The trader enters short immediately. The next candle is bullish and breaks above the pattern. Result: loss due to a false signal. How to avoid? Wait for confirmation, the next candle should follow through in the expected direction. Combine with indicators, example RSI, MACD, or price action cues, example rejection wicks, support/resistance zones. 2. Ignoring market context. Mistake, trading patterns in isolation, without considering the broader trend, support/resistance, or economic news. Why it's risky. Candlestick patterns gain validity when they form in meaningful locations. Ignoring context leads to weak signals and failed setups. Example: a hammer forms, but it's in the middle of a downtrend with no clear support nearby. Trader enters long assuming reversal. Price continues downward due to broader trend pressure. Result: loss due to lack of context. How to avoid? Identify trend direction using moving averages or trend lines. Only trade reversal patterns at key levels like support/resistance or Fibonacci zones. Monitor economic news that could influence volatility or direction. 3. Overtrading based on single patterns. Mistake, taking every candlestick pattern that appears without filtering for quality. Why it's risky. Not every pattern is trade-worthy. Overtrading leads to emotional exhaustion, poor decision-making, and unnecessary losses. Example: trader sees multiple dodgy candles across several time frames and enters multiple trades. Many trades are false signals or overlap in risk. Result: portfolio drawdown due to overexposure. How to avoid? Stick to high probability setups backed by confirmation. Limit trades to a maximum number per day or only during your A+ setups. Journal trades to reflect on patterns that work best for you. 4. Poor risk management. Mistake, using oversized positions, skipping stop-loss placement, or risking too much per trade. Why it's risky. Even good trades can fail. Without risk controls, one bad trade can wipe out your gains or worse, your account. Example: a trader risks 20% of their account on a bullish engulfing trade. Trade fails due to a false breakout. Account suffers massive loss. Result: emotional panic and lost capital. How to avoid? Use a fixed risk per trade, example 1 to 2% of your account. Always set a stop loss based on price structure, not emotions. Use risk-reward ratios of at least 1:2. 5. Failing to backtest strategies. Mistake, applying strategies live without knowing their historical performance. Why it's risky. Without backtesting, you have no idea whether a strategy actually works. It leads to unrealistic expectations and unpredictable outcomes. Example: trader sees a YouTube video promoting the morning star as a powerful reversal signal. Applies it blindly in live trading. Results are inconsistent, leading to frustration. Result: confusion and wasted capital. How to avoid? Backtest every strategy using at least 100+ data points. Use tools like TradingView, MetaTrader, or backtesting software. Keep a trading journal to track live performance and refine strategy. Conclusion: discipline over impulse. Every trader makes mistakes. The key is to recognize and eliminate repeating errors through discipline, preparation, and patience. Success doesn't come from trading more, it comes from trading smarter. Top tips to avoid mistakes. Never trade without a plan. Stick to setups you've tested and trust. Track every trade and review your results weekly. Stay emotionally detached from outcomes. Chapter 11: Developing your candlestick trading plan. A well-structured trading plan is essential for consistent success in the markets. It serves as your roadmap, guiding decisions, and helping you navigate the complexities of trading with discipline and clarity. This chapter will walk you through the key components of building a personalized candlestick trading plan. 1. Define your trading style. Your trading style should align with your personality, risk tolerance, and available time. Common trading styles include scalping, day trading, swing trading, position trading. Example: 2. Select time frames and trading instruments. Choose time frames and instruments that complement your trading style. Time frames: scalping, day trading, swing trading, position trading. Trading instruments: Forex pairs, stocks, commodities, cryptocurrencies. Example: 3 build rules around candlestick signals. Establish clear criteria for entering and exiting trades based on candlestick patterns. Entry rules, exit rules, stop loss, take profit. Example: 4. Use a journal to track trades. Maintaining a trading journal helps in evaluating performance and refining strategies. Record details. Review regularly. Example: 5. Review and adjust monthly. Regularly assess and refine your trading plan to adapt to changing market conditions. Performance analysis. Plan adjustments. Example. Conclusion: developing a personalized candlestick trading plan involves. By systematically implementing these steps, you can enhance your trading discipline, make informed decisions, and increase your potential for consistent profitability.